Silver climbed 9% this week to 84.57. Gold reclaimed 5,100. And both of those moves happened with China completely offline. Mark here from GoFinance. Let me say that again because this is the most important detail you'll hear today. The largest physical demand engine on the planet was dark all week for Lunar New Year. Shanghai Gold Exchange closed, Hong Kong banks closed, billions of dollars in daily liquidity vanished, and silver still rose 9%. Now ask yourself, what happens Tuesday when Shanghai reopens? Drop a comment right now, just 2 words. GoFinance. That tells me you're here. That tells me you're paying attention. That's all I need. Now let's get into what actually happened in Comex registered silver this week. Registered silver, the metal that is genuinely warrant issued and available for physical delivery against futures contracts, sat unchanged at 88.19 million ounces going into the weekend. No inflow. The February contract is essentially finished. And what stands out is not just the absence of outflow, it's the complete absence of new metal coming in to replace what has been draining. Eligible silver, the broader category sitting in vaults, but not immediately available for delivery, continued shrinking. Another 1.2 million ounces left eligible inventory in a single session. Total Comex inventories are still seeing net outflow even as the registered figure holds flat. Here's why that matters structurally. The March contract, open interest, still sits at roughly 222 million ounces. Registered silver is at 88 million. That implies a deficit of well over 134 million ounces between what is deliverable and what is theoretically owed. And the roll from March to May is still far too slow. Only 15 million ounces rolled in a single day. And with 4 trading days remaining before March enters settlement, the math does not add up. If you're watching this and thinking, that sounds like a structural problem, it is. Check the Comex inventory reports yourself. They're publicly available and updated daily. The ones who actually pull these numbers understand why the roll pace matters. Subscribe to GoFinance if you haven't already. Drop a comment and tell me, have you ever actually checked Comex inventory reports yourself? Or are you just trusting what analysts tell you? I read every single comment. Now, here's where it gets interesting. China was offline for Lunar New Year all week, one of the largest physical demand engines on the planet, essentially dark. The conventional logic said metals would struggle without Chinese participation. Silver was up nearly 9% by Friday's close, printing 84.57 on the futures. Gold reclaimed 5,100. Both of those moves happened with China absent from the market. Let that sit for a moment. The next question is the only one that matters right now. What happens Tuesday when Shanghai reopens? Here's a data point that answers that question better than any forecast. The largest silver recycling company in Shenzhen, one of China's primary precious metals trading hubs, was offering the equivalent of $93 per ounce to buy back 9999 pure silver going into the weekend. That is the physical bid inside China with their own exchanges still closed. Western futures are at 84. Shanghai spot was already running at 86. When the Shanghai Gold Exchange reopens Tuesday, the premium differential and the physical bid underneath the market are going to make themselves known immediately. The ones who track these spreads know what a $93 physical bid from a major recycler means when the exchange price catches up. This connects directly to something I've been saying for months about the physical paper disconnect. The Silver Institute and structural supply data have confirmed we are in the 6th consecutive year of silver running a structural deficit. Annual global mine production is approximately 800 million ounces. Projections for 2026 show a deficit approaching 300 million ounces, more than a third of everything the world extracts from the ground in a full year. That is not a rounding error. That is a compound structural failure that paper markets have been papering over with forwards, leases, and rehypothecation for years. About 75% of you watching aren't subscribed. If this inventory math is eye-opening, hit subscribe. Now, let me show you the story beneath the story. There's a story about what actually happened between JP Morgan, China, and the silver market over the past several months. And almost nobody is covering it. China had spent years buying the dip in silver, conditioned by years of suppressed prices to treat every pullback as an opportunity. That behavior created an addiction to cheap silver that left Chinese industrials structurally short when the market shifted. When JP Morgan pulled 13 million ounces off Comex registered inventory and reclassified it to eligible, meaning it disappeared from the deliverable pool, a Chinese industrial that had tried to hedge its short position on Comex and take delivery was told in plain terms the silver was not available. What followed was a short squeeze. China went limit up as the short covering orders hit a market that could not absorb them. JP Morgan, according to documented refining and market sources, spent the following weeks filling that order, pulling silver concentrate from Latin America. While Chinese buyers attempting to source the same material were told it was already contracted. One Latin American producer confirmed being offered $80 an ounce by Chinese buyers, $10 above prevailing prices. because JP Morgan had already locked up the supply. Vince Lancy, publisher of the Gold Fix newsletter, has documented this sequence in detail. His framing is worth understanding. This is not a metal story, it's a proxy war. JP Morgan acting as a proxy for Fed interests. The PBOC operating through its own market representatives. Silver is the battlefield where that conflict is most visibly expressing itself right now. And the Chinese market structure made things worse. A listed open-end fund in China was trading at 30% above its net asset value as retail and speculative buyers piled in. When the industrialists who needed lower prices to cover their shorts pressured regulators, the fund was switched to liquidation-only mode while silver was still elevated. Sound familiar? It should. The Hunt brothers know exactly what liquidation-only looks like. The difference this time is that the forced unwind did not kill the market. Silver held. The physical demand underneath the paper structure was too large to be crushed by a single regulatory intervention in one country's market. Now let me give you the honest countercase, because this is where the ones who do their homework separate from the ones who just want confirmation. A stronger dollar creates mechanical headwinds for dollar-priced metals. The yuan hitting its strongest level against the dollar since May of 2023 is notable. A strong yuan reduces the hedging incentive for Chinese buyers and can dampen import premium dynamics at the margin. Silver's move from 79 to 84 in a single session last week also created a pocket of traders sitting on short-term gains who will look for any excuse to take profit before continuation. And some of the supply-demand projections, including the large deficit figures, are institutional forecasts, not realized outcomes. Supply responses can alter trajectory. These are real variables, not excuses. Anyone managing actual capital has to account for them. But here's what the data shows that the forecasts do not capture. The LBMA, the hub of the global silver lending market, effectively ran out of above-ground available stock. Lease rates exploded when the interdealer lending network inside the hub seized and banks had to go public to borrow silver. That is not a forecast. That is a documented market event. When the interdealer market stops leasing to itself and has to advertise publicly, it means the informal cushion is gone. Howard Marks wrote in Mastering the Market Cycle that cycles are not driven by fundamentals alone. They're driven by what happens when the credit and liquidity structures built around an asset finally have to face physical reality. The LBMA lease rate explosion was exactly that moment. Shanghai reopens. Physical bids inside China are already running $9 above Western futures. The Comex March roll is dangerously slow with 4 trading days left. Gold is above 5,100 with China offline. And the yuan just strengthened to levels not seen since May of 2023, which tells you something about capital flows and the pressure on dollar-denominated reserve systems. Now let me show you what happened to sentiment during the dip. When silver dropped into the 72 range, almost every voice in the metal space flipped. Suddenly, everyone was bearish. Capitulation language everywhere. I told you we had a structural support zone between 70 and 72.60. I told you there was a bullish swing failure pattern, and I made it your homework to mark it on your chart. I told you there was a potential inverse head and shoulders forming. Nobody was talking about that setup when the sentiment was dark. Nobody. Now silver is at 84.60. That is not coincidence. That is what happens when you read the structure instead of reading the headlines. And before anyone gets ahead of themselves, that is not me saying we're going straight to all-time highs from here. That's not the point. The point is what happened to sentiment on the way down and what happened to it on the way back up. A 5 to 10% drop and everyone flipped bearish. Same people, 5 to 10% recovery, suddenly bullish again. Complete opposite conviction every single time. If that is driving your decisions, you are not reading the market. You're being played by it. And there's a reason sentiment behaves exactly the way it does at those moments. The 1974 U.S. Embassy cable, a declassified government document, not a theory, not speculation, an official document, openly described how a large gold futures market would make physical trading seem minuscule, amplify volatility, diminish demand for physical metal, and discourage citizens from long-term holding. They understood the psychology 50 years ago. Flood the market with paper. Amplify the dips. Let sentiment do the suppression work for you. You don't need to force people to sell. You just need to scare them enough that they do it themselves. When silver hit 72, sentiment did exactly what it was designed to do. Almost everyone sold the narrative instead of reading the tape. The structure never lied. The headlines did. Now let me show you why Tuesday matters so much. Shanghai reopens with a physical bid inside China running $9 above Western futures. Comex registered silver has not seen a single ounce of new metal enter the deliverable pool. And the March roll is dangerously behind with days left to settlement. Gold held above 5,000 with China absent from the market. Think carefully about what that says about the demand structure. and the silver market itself, which was structurally built to function under $30 per ounce according to everyone in the supply chain who watched it seize up during the initial move, is now operating at nearly 3 times that level, with physical demand that is not going away. The unresolved question, and this is the one to watch, is whether the Comex March settlement produces a genuine delivery demand that cannot be absorbed by the current registered inventory. The math between 222 million ounces of open interest and 88 million ounces of registered silver does not close quietly. Watch the roll pace Monday, watch the registered figure Tuesday morning, and if you haven't pulled those vault reports yourself, now is the time to start. About 75% of you watching aren't subscribed. If this breakdown is showing you market mechanics you've never seen before, hit subscribe. Drop a comment and tell us, will you actually verify the Comex data yourself, or just trust what others tell you? Now let me give you the bottom line. Here's the bottom line heading into Tuesday. Shanghai reopens with a physical bid inside China running $9 above Western futures. Comex registered, silver has not seen a single ounce of new metal enter the deliverable pool. And the March roll is dangerously behind with days left to settlement. Gold held above $5,000 with China absent from the market. Think carefully about what that says about the demand structure. The silver market itself, which was structurally built to function under $30 per ounce, is now operating at nearly 3 times that level with physical demand that is not going away. The unresolved question is whether the Comex March settlement produces genuine delivery demand that cannot be absorbed by current registered inventory. The math between 222 million ounces of open interest and 88 million ounces of registered silver does not close quietly. Let me show you what to watch specifically. Watch the roll pace. Monday. If it stays at 15 million ounces per day, that's only 60 million ounces rolled before settlement, leaving 162 million ounces still open. Against 88 million registered, that's a problem. Watch the registered figure Tuesday morning. Does new metal enter the deliverable pool, or does it stay flat? If it stays flat, that confirms no new supply is coming to relieve pressure. Watch Shanghai Premium when the exchange reopens. Is it still running $6 to $9 above Comex, or does it compress? If it stays wide, that confirms physical tightness in China despite the holiday. Watch yuan strength. It just hit the strongest level against the dollar since May 2023. A strong yuan reduces hedging incentive for Chinese buyers at the margin, but it also signals capital flow dynamics that favor hard assets over dollar reserves. These are the data points that matter, not sentiment, not headlines, not Twitter panic. The primary sources are publicly available. Comex inventory reports updated daily. Shanghai exchange data when it reopens Tuesday. LBMA lease rate history. The ones who look find exactly what the data shows, and they stop needing anyone to tell them what to think. Now let me address something important. Some people come here suspicious. That's fine. But there's no sales pitch here. No course, no membership, no affiliate links, just data, just structure, just what the market is actually showing. And if you verify what I've shown you against primary sources, you'll find it checks out. Every single data point I gave you is publicly documented. Comex reports, Shanghai exchange data, LBMA lease rates, the 1974 embassy cable. It's all there. The question is, are you willing to look, or are you content trusting headlines and sentiment? Because the difference between those two approaches is the difference between reading the market and being played by it. Do your own due diligence. Understand the risks. This is not financial advice, but the math is the math, and the math doesn't add up. 222 million ounces of open interest, 88 million ounces of registered silver, 4 trading days to settlement. Either the roll accelerates dramatically, or new metal enters the deliverable pool, or Comex faces a delivery demand it can't absorb. Those are the only 3 outcomes. And based on the data, option 1 and 2 aren't happening fast enough. Which leaves option 3. Now let me give you the final framework. Here's the framework for how to think about Tuesday and the week ahead. If Shanghai reopens and the premium compresses, meaning Chinese buyers aren't bidding aggressively, that signals demand softness, bearish short term. If Shanghai reopens and the premium stays wide or widens further, meaning the $93 physical bid from Shenzhen recyclers translates into exchange buying, that signals continued physical tightness, bullish. If Comex registered inventory sees new metal enter the deliverable pool, that relieves March settlement pressure, bearish for squeeze thesis. If Comex registered stays flat or continues draining, that confirms no new supply is coming, bullish for squeeze thesis. If the March to May roll accelerates above 20 million ounces per day, that reduces immediate settlement pressure, bearish short term. If the roll stays slow at 15 million or below, that leaves massive open interest heading into settlement, bullish for delivery crisis. These are the variables. These are the data points, not sentiment, not headlines, not fear or hype, just math and market structure. And based on what we've seen so far, the math favors tightness. Silver rose 9% with China offline. That shouldn't happen if demand is weak. Physical bids in Shenzhen are running $9 above Western futures. That shouldn't happen if supply is abundant. Registered inventory hasn't seen new metal in weeks. That shouldn't happen if there's excess supply waiting. The March roll is dangerously slow with 4 days left. That shouldn't happen if everyone is comfortable settling. Every data point suggests physical tightness colliding with paper abundance. And when those two forces meet, something breaks. Either price goes vertical to clear the market, or the exchange intervenes with forced cash settlements or margin hikes. But the current setup doesn't resolve quietly. Do your own due diligence. Verify everything I've shown you. Pull the Comex inventory reports yourself. Check Shanghai exchange data when it reopens Tuesday. Look at LBMA lease rate history. The primary sources are there. They've always been there. The ones who look find exactly what the data shows. And they stop needing anyone to tell them what to think. My only goal is to make you sharp enough, precise enough, independent enough that you don't need anyone to tell you what to do. Not the headlines, not the crowd, not even me. The goal is for you to become the apex predator, the highest in the chain. That's what this has always been for. So here's what I want you to do. Comment GoFinance if you're actually going to verify the Comex data yourself this week. Not just watch this video and move on. Actually pull the reports, check the numbers, see if what I showed you is accurate. Because that's the only way you learn, not by trusting me, by verifying for yourself. And when you do, you'll realize the market structure is screaming what's coming. Tuesday, Shanghai reopens. Physical bid, $9 above futures. Comex inventory unchanged. March roll dangerously slow. The market hasn't seen Tuesday yet. And based on the data, Tuesday is going to be interesting. Drop your take in the comments. What do you think happens when Shanghai reopens? Premium compresses or widens? This is Mark from GoFinance. The math doesn't lie. The headlines do. Stay sharp.